what you need to know about cash flow to understand a project business case. My name is Guilherme and I'm a project management specialist. I help professionals to become successful project managers. Before I start, this is part of the warm-up for the project management journey. The project management journey, it's a week of content I'm going to make talking about how to develop or how to accelerate your project management career. So I'm going to talk about how to prepare your CV, how to prepare for interviews. I'm going to talk about waterfall, what agile. I'm going to talk more about finance, different topics from today, of course. I'm going to talk about how to improve your decision-making process for projects. And of course, then there's going to be some exercise and there's a chance for Q&A and so on. This is a special week. The content will be available only during this week and everything is free. So if you're interested in that, just go in the link in the description of this video here and subscribe. Again, everything is free. I want to make sure I'm adding value for you. So make sure you participate, you watch everything, you join the live session, and you ask questions because then we can make the most of this week and I can support you in the best way for your project management career. So the topic for today, cash flow for business case. And why I decided to do that? A lot of times people think that you are a project manager, like what you have to do with finance? Well, finance is one of the main ways that every company that most of companies use to measure value. And the ultimate goal of any project is to deliver value. Meaning that companies, so they use finance, they create business case, so they can measure the value that the projects are delivering. So if you do not have a minimum understanding about finance, if you do not have a minimum understanding about a business case, you're going to have a hard time to manage, of course, the project business case. Then you're going to have a hard time making sure that your project is delivering the value that the company needs. And again, I'm talking about finance for project managers. I'm not teach you to be an accountant. I'm not teach you to be a finance analyst. Of course, if you know that, beautiful, great. But you need to understand some basics because then you are going to see when you start to work in a project, you are going to see a business case. Usually it's in Excel and you need to have some understanding about finance, some basic understanding about finance. In a business case, you see a mix of income statement, balance sheet, and a cash flow statement. What I'm going to do here is a bit to show you on a real case. I just Google it, the income statement from Amazon and the balance sheet from Amazon. I'm going to show here to focus on the operational cash flow to show you how you do that. And of course, I'm going to explain the step by step there. But first, why I'm using Amazon? Because it's available data. You can do it for any type of company. And if it's a company that's negotiated in the stock market like Amazon, you can just download their finance information and you can use it as an example. So it's easy. And I'm using, of course, Excel. Why? Because most of business case for all companies around the world are using that on Excel. You might see something different, or you might see something on Google Sheets like you have on the screen right now. But yeah, it's equivalent for Excel. So again, and I always highlight this a lot because I've seen through my career a lot of project managers fail because they do not have a minimal understanding about finance at the point that they cannot understand a business case. They cannot enroll in a discussion. And basically they are left at the margin of the project and in the decision-making process. And sometimes they even have questions they have to follow up, but it's really hard if you do not understand it. So let's start. Basically, what you can see here in my screen then, it's the income statement from Amazon. In the income statement, you can see the basic information there. It's every time all the income statements, they have the same structure. For some of the items, you might see one name in here, one different type of name there, but the structure is always the same. So the accounting system all around the world is the same. Okay, I cannot say all around the world because there might be a country out there that the accounting system is different, but most of the countries use the same accounting system. And so you can look for companies in the US, you can look for companies in Europe or in any type of the world. If it's a company that's negotiated in the stock market, you're going to find something in this format. And this is also a bit of the beauty of having this basic understanding about finance, because once you learn it, you can use in any part of the world, in any type of the company. And again, uh, I've never seen a company where finance was not important, why finance was not relevant. Why? Because a company that does it's not profitable, it's not sustainable. So you even say, okay, but there are the non-profit companies. Yes, but even in the non-profit companies, finance is important. Why? Because they do not have a lot of money. So they need to use what they have there very wisely to make sure that they can run the business and the company can be sustainable. So in the income statement, you have your basic structure where you're going to see your sales, cost of sales, of course, gross profit, operating costs, operating margin. Then you see a lot of other stuff like interest. If usually companies they lend money, or sorry, usually companies they borrow money so they can leverage their results. Why? It's, sometimes they don't have all the money. If they want to make an investment, it makes sense they can get the money from bank or for any other types of investments that you can find out there, like bonds, shares, and so on. And that makes them for easier to operate. So if you have this time every time the same structure, and the income statement is usually the starting point of a business case. So exactly the same structure that you're going to find here, you're going to find the business case. Why? Because the structure itself is the same. That's why I mentioned. You're selling products, you're selling X amount of products, you're selling these for Y price, and what's your revenue? Number of products, they multiply by your selling price. So this is not rocket science. I know that a lot of people they get scared when you talk about finance, and I've seen again, like a few years ago, I was working in a project. Then we start to have discussions. In this case, was about capex, and then I start to have those discussions about my project, which end up creating other questions in other projects. And then in a meeting, and then in this case, the director asked about the capex for the other projects, and the other project managers they they would not know what's capex, which by the way stands for capital expenditure. That's some money that the company wants to invest, like to grow an operation. That can be the company can invest in a building, or if it's a production, they can invest in a production line, or any other types of things that you can imagine are there. And because those guys they did not know it, then then later I found out they were not even tracking their business case. And later the company found out that yeah, they were having problems with their projects because the business case was not there anymore. It was not profitable anymore. Then this is probably the worst case scenario that you have. That you've worked like for times 1, 2, 3 years in a project, and the company is thinking that everything is going well. Then at the point that you are about to put something into production to start selling, the company figure out that they're not making money in this project anymore. Meaning that if they want to sell products, they can because of course they're already investing in the development, but then they are losing money then. Then that creates a lot of discomfort inside of the organization, a lot of people trying to blame, depending on the culture of the company, of course, but it's not nice. And you can avoid it if you know the basics, because that's also the thing. If you have a project business case, which you are always updating it, keeping things going are much faster. Then here again, the Newton's law of inertia, it's very applicable. Because if you haven't done anything, then if you're in a, in a rest state there, talking about physics in this case, and the effort to make things moving there, meaning that if you haven't taken a look in a business case for 8 months, then suddenly someone asks you to update, it will take you a lot of time and a lot of effort to come up with a good business case and update the business case. However, if every month you're checking it, you're updating whatever changes, if there's any changes, otherwise you just confirm what's there, and someone asks you, can you provide me an updated business case? Yeah, you can do it fairly easy. And that's of course something that I really stress and discuss in all the trainings I do, because again, finance, it's a blind spot in a lot of project managers. Why? Because a lot of project managers, they end up as being project managers because they start to get promoted, or maybe they were engineers, or they were working in another part of the team. Then they show that they have some organizational skills, and suddenly they say, you're a project manager, but they do not have a training, they do not have a proper advising, showing them. They say, hey, the business case, it's important, you need to understand those basics on the business case and really understand it, because a lot of people, they can talk about this is an NPV, this is an internal rate of the return, but they do not understand what's an NPV. They do not understand the concept of an internal rate of return. So saying the terms without understanding, that's useless. It's not about showing off, say, okay, I'm going to memorize all the terms, I can use this in a bunch of meetings, then I'll look good. No, that's not about that. It's about understanding the concepts, so you also know how you direct your project, because that's what it means. Like if you negotiate a different payment condition with the supplier, a better one hopefully, you understand, okay, that might help here in my cash flow, depending of course what you're negotiating there, but that might help in your cash flow. Well, if you have a more lean production, which you're looking for a pull system with very low stock items, well, that helps you your cash conversion cycle, that helps in your inventory cycles, which means that also helps you your business case. So let's first talk about the business case. So the income statement is the first part of the business case. It's basically how you create that. I just mentioned what are the steps. Then here I'm showing you here the balance sheet from Amazon. Then you have here the asset part. You have here the equity or the liability and equity part. Remember here that if you do not know it, but the assets, the total assets, they are always equal to the total liabilities plus the total equity. So that's why you see the number exactly the same here. So how, if you have a balance statement like that, how you go from a cash flow? You see here the years, then you have 5 years information from 2018 to from 2022. Usually you need to have, because the cash flow, the cash flow, it's basically a picture of a bank statement in a given point in time. It's like your bank account. If I go and ask you what's the exact value of your bank account today, you're going to tell me, I don't know, it's 100. But if I ask you tomorrow what's the exact value of your bank account, might be a bit different. Why? Because you might go, I don't know, in the supermarket and you might buy a Coca-Cola. Then it will be less than 100 euros. And every time you're going to buy something, the amount of your account will change. And every time you receive money, you get paid, the amount of your account will change. So this is not a static value. On the cash flow, that's something that's changing every day. Same thing for the company, because companies, they pay suppliers, they pay salaries, and they have all kinds of expenses they need to make there. So in a picture like that, as a balance sheet, you're capturing what's the state that a company have in a given day of the year. So it's a picture, meaning that the next day things are probably different, because you have things like inventories that they're always going to change, they fluctuate every day. So of course, if you're doing a balance sheet here, you're going to start with your net income. Well, your net income comes from your income statement. It's basically what you sold minus your costs, very roughly. Then you start here, what's your net income? In this case, I'm starting your net income from 2019, which I'm going to explain why 2019. Okay. Then you have something also in your balance sheet that's called that you have something else to consider in your cash flow, because as I mentioned, cash flow, it's your bank account. Then you have something that's called depreciation, which means depreciation, it's a money, a kind of saving. It's a tax shield that a company can have in their investments to make sure that they can save some money, between brackets, to make future investments and make sure that they can keep operating. Changing a bit the language, what would be that? If you buy a house, your house needs maintenance, and then you need to continue investing there. And if you buy a house for 100, you can depreciate those house through the years. Why? Because if you do not do maintenance, the value of the house will start to go bad, break it, and at some point it's end of life. It's the same idea with an equipment. So the idea of the depreciation, that you're going to buy, that the company buys a house, but they have a tax incentive to make this saving, again between brackets, so they can have money to invest in something again in the end of the life of the product. And why I'm talking about that? Because depreciation is usually, or depreciation is associated with an investment. So for example, you can have a capex, a capital expenditure, if that you need a new production line. Then you need to invest in this new production line, and you need to depreciate this production line through the years, meaning that because through the years the production line sooner or later will end the reach of its life. But what's the thing about the depreciation? It's not a value that it really goes out like that from the bank account of the company. Why? Because if you, in the same case of as a house, you're going to have this investment done upfront. However, in the accounting system, you are going to enter this depreciation. It can depend. There's different types of depreciation anyway, but you are going to take piece by piece in all those years that you are operating something. For example, if you have a depreciation for entire project, 10-year project, for 1 million pieces of any type of product, you can divide your investment by 1 million pieces, and a part of your investment will be in the cost of each of those products that you're selling. So in this case of Amazon, you cannot see the depreciation straightforward here, but the depreciation, I know that depreciation is included there, even if it's not like that. That's why I got some extra information. But then coming back to the point, why it's important to come back to depreciation here, because the company already paid for that. Then maybe the company already paid for that in 17 and in 18. So this money is not a money that's going out of the bank account of the company this year. It was already done in the past. So you can add the depreciation here. I see I got another declaration just to know what's the depreciation value, and you add this amount back here. Then you have the inventory. Let me on accounts. You have the inventory. What does it mean, the inventory? Basically, if you produce something, like Apple produce iPhones, they store a bunch of iPhones in stock, and this has a value. Why? Because if they sell, they make money. If they do not sell, it's on stock, but it has a value. So as an inventory, you have this value there. And in a balance sheet like that, how you are going to calculate the inventory? You're going just to calculate the inventory variation. In the other words, the inventory delta, meaning, for example, if Apple, they had 10,000 of iPhones in the end of 2018, that corresponds to an amount of money. Then that's here is in dollars that you would see in the inventory. However, if by the end of 2019, instead of having 10,000 iPhones, they have 20,000 iPhones, that means they produce a much more, but they did not they did not get the money. Why? Because they did not sold it. That means that they are increasing their amount of working capital. So in practice, when you are looking for variation, for example, for the 2019 cash flow, you are going to look for the what's the inventory of 2018 minus the inventory of 2019. Why in that order? Because in the case that the inventory levels are higher, that's more money that the company is buying, for example, in raw material, there's more money they invest in production. So the value in the inventory is building, the final product, remember, it can be an iPhone, but can also as well be, I don't know, any other thing. Here we are using Amazon, it can be any type of product from Amazon, like from Kindles or Fire, or I don't know, any other type of things that you buy directly at Amazon. So that means in this year, Amazon invested here $3 billion in inventory. Ideally, of course, you want these numbers going down, but that's not always the case. Of course, in this case from Amazon, it's a bit different. You see the inventory numbers are always increasing, but also their sales were falling. But that's a different discussion about operations of the company. Then you have something that's called accounts receivable. Accounts receivable basically means that the company sold something and they are going to get paid one time in the future. For example, if you buy something from Amazon, you buy it using your credit card. And Amazon will not get the money right away from the credit card company. And depending on the kind of negotiation they have, they usually get the money 1 month later or maybe 2 months later. That means from the point that they sell something, it takes time, so they are going to get the money. And that's normal for all types of business, because most of the times, unless like you are going to the supermarket and you pay with cash, then there's no accounts receivable in this case. For any other types of payment, or most of the other types of payment, if they are talking about credit cards or invoices where the companies, how the companies operate to get paid, usually there's a different payment condition. And what that means, having a high amount of accounts receivable, that means that the money has a lot of money to receive, which in theory it's a good thing, but longer the company takes to receive this money, that means that they need higher investment in their working capital to keep running. Because you can imagine, for example, you are buying stuff in Amazon, and the Amazon will get the money from everything you buy, for example, in 2 months, exaggerating here. However, they need to pay salaries. They cannot wait 2 months to get all the money to pay the salaries from this month. And they cannot tell the employees, hey, by the way, wait 2 months until we get the money. So companies, they need what's called working capital. That's like the money that they keep operating until they produce something, they sell something, and then they really get the money back there. And accounts receivable, it's one of the items from the working capital. Then you have from working capital the inventory, accounts receivable, and accounts payable. So if I'm going to do this cash flow here for 2019, how I would compare here, because I'm talking about the money in the bank account, then I want to look also for variation. Why variation? Because the amount of the bank account can change every day, and you see here even the date that those numbers are reflecting. But I want to see if from 2018 or 2019, Amazon, they increase their accounts receivable, meaning that they need to invest more money in the working capital, and this money needs to come from somewhere, or it means that they are they reduce their accounts receivable, that means they can get the money faster there. So let me do this. Accounts receivable. You see here from Amazon they have customer, vendor, sellers, and whatever. I'm just going to make again the order here. It matters. Why? Because if the accounts receivable increase, that means the company is investing more, then it's a negative item, the cash flow. If the accounts receivable reduce, it means that the companies get more, they get the money faster if they're selling more. And then the cash flow is positive. Oops, what's happening here? Let me go back. Then you see that's negative here. And you have what's called there the accounts payable. Accounts payable, it's the same idea about the accounts receivable, but it's looking for the suppliers. So every supplier that delivers something for a company, they have some payment terms. That means that, for example, they're going to deliver raw material. Like if you're building a house, construction, the supplier goes there one day and deliver concrete, and usually the supplier will send you an invoice and you're going to pay this invoice, I don't know, in 15 days, 30 days, 60 days, or whatever payment condition that you have negotiable here. So that means in this case, if you increase your accounts payable, it's good for you. Why? Because it means that you are taking longer to pay your suppliers. It's a positive thing. So in this case, when you make the calculation about the accounts payable, there you make the calculation in the other way, meaning that if the accounts payable are increasing, that's a good thing for you. Then it's 2019 minus 2018. That again, what does it mean? It means that you negotiated better conditions and you have more time to pay your money. Why? Because this is influencing the accounts, the working capital. You can imagine from the time a company delivers any type of raw material, then you need to produce something, then you need to put in inventory, and then the company sells it. Of course, if you're talking about a construction company, you might not have inventory, but then you have, for example, in the case of concrete, you deliver the concrete, then you're going to build, I don't know, a house. Then at some point while you are building the house, you need to pay your supplier. Then the house is ready, then you're going to invoice your customer, then you're going to get paid. So there's always those gaps and those differences. And that's, again, where the working capital will enter. It will help you to manage those kind of things here. So with those 4 items, you have what's called the operating cash flow from a company. Why it's operating? Because this comes exactly from operation of the company. Inventory, the company, what's the stock level, accounts receivable and accounts payable. All those items here, they come directly from the operation of a company. But I mentioned, and let me see if there's another interesting item that I need would be nice to explain. Yeah. So you see here different types of items, like the company have cash because the beginning of the cash position there. All those items in a balance sheet they are called current assets. Why? Because current assets are short term, less than 1 year, assets that a company can have that can help the company to gain liquidity. What means liquidity? It means like cash. If you need money, you have money in your bank account, you can go to the supermarket very easy. If you have an inventory and say, I need to sell an iPhone, so I get money to buy my grocery, that's an inventory, for example, that you could have. But of course, it will take more time, so you cannot go in the market, you cannot go to the supermarket right away. So in general, that's called what it's account receivables. And you have the same idea for the current liabilities. What are the current liabilities? Are the accounts payable and like short-term money that the company can get from financing. There's something also interesting here, the accrued expense concept. and you can also have an accrued revenue. Why this is important? Because this is very relevant when you are talking about cost management. Because depending on how the companies that you are working on are operating, their invoicing system and their accounting system, you can have what's called always an accrued expense. What's an accrued expense? For example, because if a company, for example, let's go back for the construction example. If the company execute, for example, delivery contract in a construction site, then the truck goes there, put the concrete in the foundation, for example, and the truck leaves. So at the moment that the truck put the concrete in the foundation, that means that this amount of value for the concrete is owned by the company. And then of course, between the truck leaves and between the concrete company issue an invoice to get paid, there's always a period. And that this period, depending on how efficient this company is, can be 1 day, 2 days, 3 days, 1 week, or 1 month, or even higher, depending on how the companies work. However, if you're working in this construction company and you do not receive the invoice, the cost will not appear in the ERP system like SAP or Oracle. That means that the company owns something for the concrete company, but they cannot see still the cost in the system. And that's what's called an accrued expense. That's something that's already owned, but you cannot see the cost still there in the system. It's to make a parallel here to try to make this easier to understand. It's kind of if you work from a company, of course, different places in the world you can get paid by week, you can get paid by weekly, by month. For example, in the Netherlands, you are paid once a month here. So if I work for a company for 1 week, even though I'm going to get paid in the end of this month, if I work there for 1 week, this company already owed me 1 week of work. And depending how can appear in the system, that usually can appear in the system as an accrued expense, so that's an amount of the company that a company won. That's an expense that a company won at the moment that the service or the service is executed or the good is delivered. That might be a gap at the point that you get an invoice. So the cost will really be processed in the system. But this accrued that's something that the company owns. And sooner or later, that the company will need to pay. Like if I work for a company for 1 week and then I decide to leave the company, in the end of the month, the company will need to pay me this week that I worked there. It's a kind of the same idea it's exactly the same idea for anything else. Like as I mentioned, a concrete supplier are going to deliver the concrete, put in the foundation, and it might take another week until the concrete company really issue an invoice to be paid. However, this accrued cost is already there, be in the system or not. And why this is so important and why I'm talking about here, not that will influence your cash flow, because this period, while the cost is really owned but the invoice is not the system, that's can vary a lot from company to company, from supplier, because depends on how fast the supplier will issue an invoice, how fast the company can process. And I've seen a lot of variation there, meaning that I've seen people saying that, okay, my cost is okay, but suddenly at some point, because a supplier was not efficient in issuing an invoice, then suddenly they issue an invoice that was on hold, I don't know, for 3 months, and you have a peak cost there that you thought that was already incurred and it's really not there. And that can create a lot of fluctuation in your cost management. But coming back, we are talking about cash flow, not cost management. So this is part of the current liabilities. Again, if you take what's the current if you take the current liabilities plus the current assets, then you have what's called the working capital. And of course, that's only the gap, because if you have money, that if you have, I don't know, in this case from Amazon, they have few millions in their bank account that they can keep paying everything. And of course, in this period, they are going to receive more monies from their account receivable, but they are going to sell more stuff from the inventory. But they always have the money that they need to pay. And this gap they need to manage it. That's called the working capital, to make sure that they have money in the account or in some form that they can access it very easily. Then they can keep operating. So this is operating cash flow. Operating cash flow. Then you also have something called, that's the investment cash flow. Well, as the name say, the investment cash flow should be very straightforward. Like Amazon, they want to grow, meaning that they need to put better IT infrastructure, more warehouse, more delivery systems in place, and they need to invest. This money, the investment can come from the operation, meaning, for example, in this case, they have a positive here of 300 million, or in this case, I believe it's billion. Yeah, 300 billion. But they need to invest, and depending how much they need to invest, or how fast they want to invest, in how fast, of course, they want to grow. So if they say they want to be in all the countries around the world really fast, then that means that they have an amount that they need to invest. And it can be all types of investment, but you see that in what's called here long-term assets. You see here property, equipment, operating leasings, goodwill, that's when they buy a company. And then you see here that they have their long-term assets here. But their long-term assets, you can, again, then you are going to look for a variation from one year to another. Then you are going to look for a variation, seeing that you're looking for a long-term asset minus the other year. Here, why I'm doing like, what happened? It's this minus this. And why it's negative? Well, because if they have more assets, if they buy more buildings, that means they need to invest the money. Then it's a negative number. But you can do also the other way around. If they have a building, then they sell it, and then you can see here the total, the liabilities. And of course, long-term liabilities can be that they are borrowing money, or they can be they're borrowing money. If like they go in the bank, they ask for more money, or they pay they pay the bank back. So here, if you see your liabilities increasing, that means that you're getting more money, because you're borrowing money from the bank. Then at some day you're saying, I own the bank 50 billion. In the other day, or in the end of the year, you say, now I own the bank 75 billion. That means that you got an extra of 75 billion. So in this case, it will be positive, the variation. But you see, Amazon invested much more, meaning that much more than the money that they got. Then there is a gap here. And of course, the intent is this gap to be supported by your operational cash flow. Then this gap is going to be supported by your operational cash flow. So in the end, you're always going to balance out the operational cash flow, the investment cash flow, and the financing cash flow. The financing can be, of course, the part that they take from the banks for finance, but also can be like dividends they pay for their shareholders. So if the Amazon is paying like 1 billion in dividends for all their shareholders, that's also money that's going out from their bank account. So that's the basically structure that you're going to see in any cash flow from a business case. And again, if you look for a cash flow in the business case, that might be much simpler than the one that you have here from Amazon, because in a business case, you're not going to have anything about dividends payment, you're not going to have equity variation. You don't have usually you don't have you're not taking a look on the total assets or total liability variation. You're only taking a look on the specific investment that was done for a specific business. However, the principle is the same, and that's why I would like to use the numbers from Amazon, because this is a real case and you can understand there. Then this is quite important. Again, if for the investments, if Amazon would sell buildings, they would make money. If they buy more buildings, that means that the cash flow is negative because they need to invest more. If they pay their banks, then if they pay their loans, the money they borrow from the banks, then the liability, the long term liabilities go down, but then also the cash is going out from the bank account. However, if the total liabilities go up, that means that they are borrowing more money, so the cash flow in the account goes up. That's more or less, in a very simple way, try to explain to you how a cash flow works. For the investment, again, for the investment and the financing cash flow, this is less relevant from a project business case. But for depreciation, inventory, accounts payable, and accounts receivable, that's something that you're going to see in all types of business cases, at least in a company that has a more mature finance program, a finance system there. And some of those stuff you're not going to need to calculate there. Then usually the company has some rates, like an average amount of time that the company keeps stuff in inventory, an average amount of time that the company takes to receive their money, and average amount of time that they pay their money. And based on those index, they are going to make a calculation to show how much extra money that you need to put in the working capital. This is very important because in the end, the company needs to plan all their projects. They need to consolidate all their business case because they need to see how much extra money that the company will need to have to support this working capital there. You can imagine if a company grows too fast, as in the case from Amazon, if you see here their sales in 2018 was 230 billion, and 2022 they more than double. That means that a lot of investments required money. Why? Because the working capital of this company needs to grow fast to make sure that they can keep operating. And sometimes it will be even faster than the money they can get there. Then this is quite important to understand in general. Of course, there's also all the finance KPIs that would be nice to understand in your company, because in the end, if you want to be a manager, you're going to be in meetings where they're going to discuss those things. But that's also a different type of discussion. Here it's only at least the basic items that I would like to explain what you need and exemplify what you're going to need to understand how to calculate a project business case. If you like the content, make sure again you follow me for more content. Like and share these videos so until it can get more people and more people can learn project management. And don't forget, this is a warm up for the project management journey. It will be a 1 week event, a lot of content there. Make sure you also enjoy this content the most, ask questions and engage with me so we can take the most in this period, and the content will be available only during this week. So make sure you watch everything there. Thank you for staying with me so far, and see you around.